In our discussion about the balance sheet, we're going to show you how to create them three main sections: assets, liabilities, and equity. Daniel, before we jump into creating the balance sheet, let's make sure our students are up to speed on some of the foundational concepts of accounting.
Every transaction involves a debit to one account and a credit to another account.
Right, and that's called the double entry system.
The accounting equation that is the foundation of accounting is assets equals liabilities plus owner's equity.
And using this equation, we can verify that our balance sheet has been created correctly. And finally, let's make sure that we have a common understanding of assets, liabilities, and owner's equities and what goes into each. Assets consist of current and long-term. Current assets are those which can be readily converted into cash within about a 12-month period. Long-term assets are for things that the company plans to keep for longer than 12 months. Liabilities refers to the debt that's owed by the company. Like asset, there's two categories, current and long-term. Current is the debt which the company expects to be able to pay off within the next 12 months, and long-term refers to the debt that expected to continue past the next 12 months. And that brings us to owner's equity. Owner's equity is the owner's interest in the company assets after all of its debts have been paid off. Let's start by discussing the balance sheet report. A balance sheet provides a summary of the assets, liability, and owner's equity, and it's derived from the general ledger. It summarizes what a company owes and what it owns. It's usually prepared quarterly, but a sample for internal use and evaluation can be provided at any time.
As I recall, it's a snapshot of these at a specific point in time, so it's static in nature?
That's correct, Daniel. It's a snapshot in time, which is an important distinguishing difference to the income statement. Another noteworthy point about the balance sheet entries are that amounts are listed at historic value until disposed or fully depreciated. This means they're not going to be adjusted to fair market value nor present value.
I've seen balance sheets with more than one period shown on them. Why is that?
Yes, often balance sheets may show past periods along with the current period, but that's really just for historical reference so that the viewer can see how things may have changed over time, but it's not required.
Here's the ledger we created in the first lesson.
That's right, Daniel. We created this in our lesson ledger entries, but we're going to use it to create our balance sheet. Now we'll hold here for a second so the student can review it. Just press continue when you're ready to move on. Recall the accounting equation, assets equals liability plus equity. Pulling a sample balance sheet will allow us to determine if we've accounted for all the transactions properly. Let's do that for company XYZ. What does its balance sheet look like? Let's look at assets first. Our accounts receivable came from February 15th sale of 250 parts at $30 each. The inventory value is that of the remaining inventory, assuming we use FIFO inventory control and specific identification value. The $4,800 in our checking account came from the $10,000 the owner put in, minus the $5,000 down for the office building and the $200 we paid for the soldering station.
Hey, what's this other bank account with $10,000?
Yeah, that's a good catch, Daniel, and we didn't mention it the last time. That's a carryover from last year's earnings, and it was in our checking account, but we moved it over to our savings account instead. And the final transaction is the purchase of the office building. If you recall, we paid $25,000 for that, put $5,000 down from our checking account, and borrowed the rest. All total, this sums up to $42,500 in assets. Now let's turn our attention to the liability side. We have $2,200 in accounts payable, which we owe for the two inventory purchases, and as Daniel pointed out, we have $20,000 in long-term debt for the office building. Now let's look at equity. The owner put $10,000 into checking this year. We started the year with $10,000. And thus far, we have $300 of retained earnings, which reflects the $750 sale, minus the $250 of COGS, which is $500 in revenue, minus the $200 we paid for the soldering station.
And voila! Assets equal liabilities plus equity.
But of course.
Let's share with the students some follow-up lessons we have that can help them continue with their transition to management.
Sure. I recommend the student review the lesson creating a cash flow statement, creating an income statement, ledger entries, and language of accounting. If you enjoyed this lesson, like us on Facebook, subscribe to our YouTube channel, and visit our website.